This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Fraud, error, and the evaluation of misstatements. First of all, a couple of definitions: what is fraud and what is error. And fraud is an intentional act involving deception to gain unjust or illegal advantage. And fraud really can happen at two levels. It can happen at the level of really the financial statements, in other words, fraudulent financial reporting. So people might overstate their profits. The reason they're overstating their profits is it will probably affect their share price. It may trigger options for management. It may attract a bigger offer from a potential purchaser. Then we have a slightly lower level of fraud, which is called the appropriation of assets, which is basically theft. So it could be cash, it could be inventory, it could be non-current assets. And by and large, most of these frauds, they're going to be, of portable assets of some sort. We have to be quite clear that it is management who are responsible for the prevention and detection of fraud. There should be a reasonable probability that auditors will detect any material misstatement, but even an innocent material misstatement can go undetected because it is recognized and accepted that auditors work on a test basis. They take samples. It's even more likely that auditors do not discover fraud because fraudsters will want to cover their tracks. It's very easy nowadays with scanners and Photoshop and inkjet printers to produce convincing documents which are nevertheless forgeries. So the auditor will not necessarily be open to any personal liability or liability for his or her firm just because they don't discover frauds or misstatements, provided they carry out the work to what might be called the accepted standards of auditing. However, the engagement team and the partners should discuss the susceptibility of an entity to fraud, and we'll see some of the indicators maybe later of why fraud might be more likely or easier to perpetrate in some businesses. Basically, if there's a lot of cash around, it's going to be much more susceptible to the theft of that cash than if all transactions go directly to and from the bank. Error is, of course, innocent misstatement. There is no intentional act behind error. There may just be, of course, carelessness. Worth perhaps looking at what we need for fraud to be committed. And essentially what we need are three kind of conditions to be met. So we need incentive. In other words, someone must want or need the money or need the illegally obtained advantage. Secondly, there has to be an opportunity for them to commit the fraud. And third, there has to be a kind of moral lapse almost. There has to be an attitude that will permit fraud. I'm sure we've all been in a situation where actually we could do with some more cash. We have to pay our rent or our mortgage or something in a week's time. There's not very much in your bank account. We've all probably been in situations where it would be easy to steal, for example, as an element of or method of fraud there. But I would hope that very few ACCA students would then complete the last step that's required and actually go from being honest to being dishonest and have an attitude which actually allows you to act out on the incentive and the opportunity. Some examples here of where these three factors might come in fraudulent financial reporting and the misappropriation of assets. We'll just look at some of these here. But under fraudulent financial reporting, profitability is threatened. And of course, if profitability is threatened, share prices might go down, there'll be disquiet amongst the shareholders, the directors may feel that their jobs are at risk, pressure to perform from some area. And if you remember, at one stage we mentioned an idea of management bias. Where management is kind of pushed a little bit into, first of all, optimism, but at some stage optimism becomes outrageous optimism, and then it effectively becomes lies. And incentives. Again, management bias can be set up by incentives. If the manager is going to be given share options and so on, provided the profits hit a certain level, then there's great incentive to try and get the profits up. That's why the share options were there, of course, and to provide legitimate incentive, but they can also provide incentive to cross the boundary, cross the line. Opportunity. If there are many estimates, what's the profit on this construction contract? Will this inventory sell, and so on? Where, in particular, the auditors are maybe out of their depth slightly. And managers can put forward convincing arguments to boost profits. And then there's a dominant chief executive, an idea that we had in corporate governance, where if you have a bullying, steamrollering type of chief executive, then internal controls can just be kind of undermined, and the board doesn't really stand up to this person. That's why in corporate governance we want the top to be split between the chief executive officer and the chairperson, so in a way one is watching the other. Poor internal controls always give opportunities for fraud. If you, in a way, don't know what cash you should have, or don't know what inventory you should have, or you can disperse cash very easily and so on, it's really an open door to fraud. Attitude, poor ethical guidance, very aggressive targets can make you kind of cross over in some way. Poor morale, almost a form of almost depression, I suppose, is almost what we're getting to here. Almost not caring whether you do the right thing or not. Under the appropriation of assets, financial pressure, personal financial pressure. You have to pay your rent, you have to pay your credit card, piling on that pressure. Where you dislike your employer and you think, well, I'll get my own back. And just good old-fashioned greed. You don't actually need the money, but you quite like the money. Opportunities, cash, high value, inventory, particularly portable inventory like jewelry, laptops, which are high value, portable, non-current assets. Again, we've got poor internal control. Then finally, the attitudes we have. Interesting one, other people's behavior. If you're in a business where you just joined it and you see all the salespeople or your department, whatever it is, let's say they all claim on their expenses, let's say first-class rail fare, even though they're only travelling by standard class. And you see everyone doing it. And you begin to then think, well, if everyone's doing it, it must be okay. It must be kind of accepted. And very soon you begin kind of following their patterns of behavior. And of course, it is potentially getting into a pattern of fraud. That's why other people's behavior, that's why, tone from the top. People talk about tone from the top, that when we're talking about ethics in an organization, the directors and the board must be seen to be ethical, and all the way down through the company, and the enforcement of internal controls, and seeing why the internal controls, and dealing properly with customers and fairly with staff members and so on. Ethics right the way through the company is very, very important and has a role in actually preventing fraud as well. Misstatements. Remember, we've emphasized this, we'll emphasize it again. A misstatement in the financial statements can be there because the amount is wrong, the figure has been calculated incorrectly. It can be there because it's presented incorrectly. perhaps in the wrong place of the statement of financial position. It should be a current liability, but actually it's a long-term liability, or the other way around. And incorrect disclosure, not in line with the ISAs. So the IASs, but remember the accounting standards say something about all of these. Accounting standards can tell you how to make certain calculations, how to take profit on construction contracts. And they tell you what should be disclosed, and they tell you how it should be presented. So when we're looking at misstatements, remember those 3 strands of misstatement, and any one of them is potential enough to lead to a modified audit opinion. If we find fraud, that we'll be looking again maybe when we get onto forensic audits, then we as auditors, and of course management, we should be interested in finding out how it's been perpetrated so that we stop it. Is it an isolated incident, or is everyone doing it? Has it been going on in many departments, many branches? How long has it been going on for? What sort of figures are we talking about? What's the financial impact? And the use of CAT here, we'll probably again deal with this again, computer-assisted audit techniques. Many frauds are for small amounts of money but repeated very often. A lot of auditing and a lot of internal controls tend to focus on large amounts. So maybe to get an invoice approved it has to be above $100, and there's no real approval done on invoices of $90. So the way in which a fraudster could get payments going, fraudulent maybe to a member of their family who sends in invoices, is to keep all of those under the 100. So computer-aided audit technique, once you have seen a fraud, you've seen the name of the company this bad amount is going to, or you've seen the bank account to whom it's going to, then CAT techniques allow you to look at every transaction in the year pretty quickly and try to identify the fraudulent ones. If up here you find that management is involved, if management is involved in the fraud, if directors are involved in the fraud, then you are on obviously a very kind of difficult area. Instantly your trust in management would be undermined. Their integrity is just ruined. And you have to think very seriously whether you need or should go on with the audit if management has proved itself to be dishonest. And generally speaking, you would be withdrawing from the audit. If you remember what we said about illegal acts and so on, if you feel managers or directors are stealing amounts, you go to the board and they ignore it. You go to the audit committee and they ignore it. You really then have to begin thinking how much further you take it. Should you report theft then to the police, for example? And we need to think, and we need to take legal advice if it's going to be in the public interest to do that. You'll probably be in the audit report stating what the problem is anyway, so almost certainly it's going to get out at some point during the audit. Reasons for fraud, or what makes fraud easier: poor internal control, particularly bad segregation of duties, we've talked about that. Poor IT control, where anyone can log into any machine and do kind of any transaction, leaving hardly any trace of who did it. Complex transactions that enable the fraudster to confuse people, to pull the wool over their eyes. It becomes difficult to spot who and what the fraud actually is. Many estimates involved again allow you to maybe cover your tracks, to say, oh, I just got it wrong, or I thought I was done it correctly, but in fact the calculation is it is so complicated, maybe you don't understand it any better. Easy to steal assets, and complex structures, complex management structures, complex group structures. Complex group structures where maybe assets go around mysteriously through the group. We're almost getting on here to enabling money laundering through the company by pushing amounts through lots and lots of group companies, some of them abroad, some of them at home and so on, and gradually losing track of what's actually happening. I mentioned again this idea of management bias, where optimism and hope at some point would have to be regarded as more kind of deliberate misstatement and maybe deliberate fraud. What do we do with misstatements? What do the auditors do with misstatements, whether caused by fraud or error? And the first thing to realize is that the financial statements are the company's financial statements. The directors are responsible for them. The auditors can't go and just put through whatever adjustments they want. You're not going to bother the directors with errors of 50 cents. So you have to make a kind of a judgment here to communicate to management at the appropriate level. All misstatements should be communicated, even relatively small ones. You should say, somebody's making these errors of 50 cents and so on. It might only be isolated, but of course what you should be doing is to make sure they're not making this error of 50 cents on every invoice they send out, like maybe leaving off the cost of postage or something of that sort. And that's why it's important to perhaps alert management even to small errors. But if it's a small error, you will only notify low-down management. Management should be corrected to asked to correct these and explain why not, if they don't. And we're talking again here, when we're talking about correction, we're talking about not clearly trivial errors. We're talking about not necessarily material errors, but beyond the trivial somewhat. And when we're asking management to correct errors, there are kind of three types of errors. First of all, it can be a factual error. Something has just been added up incorrectly. Why wouldn't management choose to correct that? And management really doesn't have much of an argument for saying no. And then you have errors which are called judgmental errors. This is where management and auditors have got a difference of opinion. The auditor thinks that the amount is wrong, is misstated, but directors claim that it's right. Sometimes as an auditor you might think that directors are just trying it on. But sometimes you, the auditor, could be wrong. Because sometimes, particularly in matters of judgment, it's management maybe who has the better judgment. And there can be a real kind of tussle, a real discussion is needed here to see which way we're going to go, whether we accept that figure or whether we still push for it to be changed. And finally, there are errors which are projected errors. This is where the auditor has done some tests, finds that on the basis of looking at 20 invoices, maybe purchases have been overstated by 3%, but that's an extrapolation. Generally speaking, you would not push that. You would not say that, therefore, the total purchases figure should be reduced by 3%, because you're only basing that requirement on looking at 20 invoices. Really, a more appropriate act would be to look at more invoices and more invoices until it becomes maybe pretty clear that purchases in general have been overstated by 3%. You want to obtain written representations from management to the effect that any uncorrected errors are non-material. And then what you have to do yourself and independently is to assess the materiality of uncorrected misstatements. And if you think they are material, then you will have to modify the audit opinion. And materiality isn't just a matter of quantity. Materiality is also to do maybe with the presentation and the disclosure. So if director's remuneration was undeclared or underdeclared by even a tiny amount, in many ways trivial to the profits, nevertheless there's a specific requirement to disclose director's remuneration, and there's no reason why it shouldn't be done precisely. And in such a case, even with that, you'd regard it as a material misstatement. If you think it's non-material, you make no reference to it in the audit report. If you think it is material, then you're going to have to alter your audit opinion.